Wonderful. Welcome all to today's impact valuation, externalities and transition finance, demonstrating financial relevance webinar. I'm gonna give it a minute or two to capture people that are just joining us now. I see there's still quite an active interaction here of participants that are joining the discussion. So I give it a minute or two, as I said, and then we're gonna kickstart promptly. Thank you. Thank you all for joining us today, and a very warm welcome to the session Impact Valuation, Externalities and Transition Finance, demonstrating financial relevance. This webinar topic is in close alignment with our white paper that was issued last week. And as a quick note up front, we have a very interactive session today, and that means we have the opportunity for everyone to post questions, post our panel round, and to do that in the Q&A box. We have the opportunities to comment via polling questions. They will be announced very shortly, so please keep your cameras ready to scan the QR codes. And we, of course, have information material that will be displayed in the chat at the end of the session that actually also supports today's comments and commentators here, or experts that are helping us to shape this debate and to hopefully make it a very insightful discussion for everyone involved. My name is Martina Macpherson. I am the Financial Markets Chapter Lead here at the Value Balancing Alliance, and I'm delighted to provide a brief and succinct keynote on the key topics, kickstarting today's agenda, and then ultimately moving from there into the panel discussion, introducing our round of experts very shortly, followed by a public Q&A, again, where you will be asked and tasked to send us your questions during the debate in the Q&A box, to then participate quite proactively in that public Q&A after the panel. And then we are ultimately closing off in an hour from now, and a recording of today's session will be available, as well as a transcript, and will be shared with all registrants, as well as be shared via newsletter, website and other means of communication from the VBA. When we look specifically at today's topics and what we define as financially relevant, we are ultimately moving beyond disclosure and to what really drives change in how capital is priced and allocated. So our focus is very practical here in regards to how impact valuation converts environmental and social externalities into decision useful monetary signals that inform transition plans and shape the terms of finance that may be in regards to coupons, covenants, portfolios, underwriting choices, and so on and so forth. So that means for us as a VBA, and you know, we are a non-profit coalition of around 30 plus multinational companies that are working to make corporate performance measurement decisions more useful and more quantifiable when it and where it concerns the monetization of impacts, for instance, on nature and society, and in translating them into metrics that can be managed or can be utilized for steering, for management, for reporting, auditing and financial analysis, and so on and so forth. When we look as the VBA into this topic here, we are seeing that ultimately our area of transition finance management is and is increasingly becoming a core topic for corporates and for investment decision makers alike. You know, over the last years already, we have seen that disclosure has become a mainstream debate. When and where that leaves us with Omnibus is a different topic for a different discussion. But ultimately, disclosure has become a mainstream topic. And that is related to climate and nature reporting, that's relating to double materiality, or to transition planning, to scenario narratives, and so on and so forth. But what we all felt, and not just since Omnibus, that there is some kind of friction. You know, we have more disclosures than actually decision grade numbers and useful metrics quantifiable metrics and numbers that can help us to make decisions and that describe impacts and dependencies in detail. So ultimately, it means we're also struggling to connect this information when it comes to capital allocation, to pricing risk, to setting hurdle rates, to choosing projects and credit terms, and of course, to portfolio construction. So our proposition today and beyond is very simple: to utilize impact valuation and externalities accounting as a bridge to actually turn fragmented, non-comparable information pieces alongside the corporate and investment value chain into monetary inputs that can be embedded in finance decisions without pretending, of course, that the world is perfectly measurable. And most disclosure answers, what are the issues, where's the value chain, which stakeholders, which targets, but capital allocation needs. So how large is the exposure today? How likely and how soon will impact be internalized? And which actions reduce risk per unit of capital? And how do we compare projects, issuers, and portfolios? So that is the gap we are aiming to close here. And so we are trying to answer what impact valuation is and what it isn't. In brief, impact valuation is not a marketing exercise and not a replacement for financial accounting. It is a measurement approach that translates environmental and social effects into a common unit, typically monetary values grounded in economics and in impact pathways. So it does three things. It standardizes magnitude across comparable units. It links externalities to financial relevance. And ultimately, it creates a decision interface. And that means it helps to look at inputs that are suitable for stress testing, for risk appetite, for capex ranking, portfolio constraints, you name it. All areas, by the way, that we are covering in our paper. And it's not a true number. It doesn't remove per se a judgment. It makes assumption explicit and fit for governance. And the bridge from disclosure to capital allocation can follow in three steps, to translate disclosure into quantified impact pathways, to monetize into decision grade metrics, and to map towards financial levers. And these might be, commonly cash flows, discount rates, and/or capital allocation. In short, disclosure becomes valuation, and valuation becomes finance. And what does that mean as a last note in regards to transition finance and the paper we have just issued? We describe impact valuation as the translation layer from disclosure to anticipated financial effects, and therefore to financing structures and capital allocation. And the principle is consistent. Monetized externalities show the value at stake, and internalization likelihood sets the financing priorities. So that means we are talking about capital budgeting and project selection. We're talking about risk management and resilience, especially around the scenarios for climate value at risk or nature value at risk. We are also alluding to points and case studies related to credit and underwriting, another area of research for the near future, by the way. And we are up and foremost, of course, talking about portfolio construction and stewardship. And we have fantastic examples here from member organizations such as Effectual, BNP, Deloitte, that have lent their expertise to that paper and to that construction process. And we're delighted to therefore show how and when and where we can move the portfolio construction debate and link it also to transition pathways trajectories that will help in turn corporate planning as well as investor applications and exercises / use cases. So that really brings me to the close very quickly of the keynote. Disclosure is necessary, but it does not allocate capital. And impact valuation is the conversion layer that translates sustainability information into the language of finance. That is in relation to comparable magnitudes, as mentioned, price risk and investable choices. And if the next decade is to be about real world outcomes, moving the plethora of pledges towards actions, not just better reports, then we also need tools that are reliably connecting the measurements to decisions. And impact valuation and externalities accounting are one of the most practical ways to build that bridge. And with that quick introduction, I'd like to kickstart the first poll to make this debate interactive, to get your views and feedback on also what we see potentially as the biggest bottlenecks in transition finance today, and to see when and how these occur. So please, we are now showing a QR code for you to scan on a slide. We would like to see and capture your answers, and ultimately we would like to briefly assess at the end when and where that information is taking us. Very interesting. The bottlenecks related to data, incentives, credibility, policy regulations. There seems to be in certain ways an equal weighting between many of these. No surprises here, but thank you. You had seen you had multiple choices to make, and we deliberately left that though to see really there are multiple constraints and challenges, and we wanted to also reflect these in the answers. Thank you for this, and thank you for your interactive participation. More information a bit at the end when we're also going into the second poll. So we are right on time, and I'd like to now introduce the second part of today's session, and this is of course up and foremost the expert panel. So our expert panelists include Wiebke Merbert, who is Partner Strategy Consulting, Adaptation and Resilience Finance and for the financial services industry at Deloitte. We have Dr. Andreas Ginschel, who is the Managing Director at Effectual, Dr. Ralf Lutz, who is at BNP Paribas. He's the Senior Advisor, Sustainable Business, CIB and Biodiversity Lead for Germany. We have Edo Schätz, who is the Head of Climate, Nature and Regulatory Solutions at Bloomberg. And we have Elena Vidrina, who is the Senior Investment Specialist, Public Markets at the IIGCC. That's the Institutional Investor Group on Climate Change. Delighted to have you all here and to kickstart the debate very promptly. I'm opening up the question, maybe Elena, with you in mind, and then the remaining participants to join in. When we are talking about demonstrating financial relevance and anticipated financial effects, where do you see the role of impact valuation in financial markets planning and in assessments for externalities and financial effects?
Good afternoon, everyone. Thank you, Martina, for a kind introduction. I'm Elena Vidrin, as just mentioned. And to start with, I'd like to say that, yes, we know that climate factors such as physical risk and transition costs are already impacting asset pricing. In one recent example, ECB has found that banks with higher exposure to climate transition risk faced significantly higher borrowing costs, about 7 to 10% higher than a repo market average. We know that absence or partial consideration of climate-related financial impacts in company reports can undermine investors' ability to assess value, results in misallocation of capital and long-term erosion of capital. From IGCC perspective and net zero investment framework, investors beginning to integrate and actively integrating these material risk by incorporating forward-looking criteria. We have 10 criteria in ANZIF to assess companies' alignment on maturity scale with the net zero investment objective. These are really centered about assessment on emission performance, capital allocation, credible decarbonization plan, disclosures, Scope 1, 2, and material Scope 3, targets, ambitions, but also things like just transition, climate governance, and climate risks and accounts. We have just seen from the poll, but also a known issue that data and coverage remains really a key challenge for climate strategies. We also see how investors, despite this challenge, are allocating in their broad-based strategies, for example, indexing in scale. recent examples IGCC brought to the fore in terms of case studies, which are accessible to members and non-members alike, from European pension funds like Ilmarine and Phoenix, Scottish Widows, that are beginning to integrate climate into portfolio construction within indices using either TPI data, forward-looking sustainability criteria, and these examples are really a showcase that there is a teeth behind all the talk we have. I'll stop there.
Thank you very much, Elena, for setting the scene and also highlighting some of the remaining challenges, very much, as you said, aligned also with what we saw in the initial polls. Maybe Andreas, what's your view from a portfolio management perspective, demonstrating financial relevance and anticipated financial effects? How can that be done through impact valuation and externalities accounting?
Well, thank you, Martina, and thank you all for listening in. We are a financial services firm working for large asset owners, and for us, the question of financial relevance of all of this is of supreme importance, because that's ultimately what our asset owners are after and what we're supposed to deliver. So externalities or impact valuation, and that's what we specialize in, it turns out to be quite relevant from a financial perspective. So we've basically built a host of strategies that are built almost exclusively on externalities or impact valuation, and the financial performance of those strategies is quite compelling and encouraging. So there seems to be a direct link, and that's also what is in the white paper that you mentioned. There seems to be a direct link between measuring sustainability by externalities, because that has sort of a lot of economic content, and the value created, and that value created turns also into return for investors. So I think that's very important in today's environment, where there's a lot of sort of questioning around that, and bringing evidence to the table that there is a link between sustainability understood in the right way and value creation and financial performance, I think is of utmost importance.
Thank you very much, Andreas. And Ralph, also, looking at BNP's work here and the work you're undertaking, especially around nature VAR, and as Andreas mentioned, we worked very closely together on this paper, also looking at the implications of climate and nature VAR. Could you maybe summarize when and where you're utilizing impact valuation and obviously externalities accounting for your specific corporate finance or corporate investment implications, and what does that look like?
Yeah, thanks, Martina, and thanks everybody for joining in this webinar. I mean, honestly, it is for debt and for equity investors all about risk and return. And in a perfect world, we hadn't to discuss impact valuation, because then we had no externalities, because every input had been properly priced. But that's not the case, as we all know. So we need something that ensures that investors are not investing in potentially future stranded assets, that something that is today perceived as granted and perceived to be free without costs, to be available without any limits, due to the regulation will become scarce and more expensive. So that brings us to a total different view of a business model. So maybe the business model has to change, maybe only part of the business model has to change. So for us, impact valuation at the end of the day is one instrument, maybe not the only one, but one instrument to make sure that capital allocation is done properly, so it's allocated to the right into the right projects. It could maybe also be one instrument to show what are the benefits of avoiding future damages versus the cost of inaction. I mean, today we quite often hear from politicians and And also in the media, no, sustainability, that's by far too expensive. We can't pay for that right now. But the longer we wait, the more expensive the entire exercise will be. So that is, for me, one of the main topics for impact valuation. In BNP Paribas, we hardly ever see it as a pure corporate play. And I know that corporations usually are using shadow pricing, impact valuation elements internally, but it's more in a research mode, let's put it that way. However, when it comes to environmental or to social projects, has been quite standard in recent years to use impact valuation. So what is the outcome? And can that outcome be achieved at a lesser price, a smaller price? That's usually when it comes to projects that are related to the public sector. And that's also the reason why it usually started with social projects. But to be enrolled into the wider corporate landscape.
Thank you very much, Ralph, for summarizing also the valuation and evaluation methods, right? That are very meaningful here when we're applying impact valuation and externalities accounting. From a capital allocation perspective and beyond, and for equity analysis and valuation, as you had highlighted and Andreas alluded to, of course, too. Bringing in Edo, looking at Bloomberg's perspective and looking at data availability, we will go into that question a bit more detail later on, but just also high level really, do you see information exchange on these data points when and where and how there is need for quantification of information and looking specifically also at utilizing additional data points, maybe for transition planning and transition finance exercises?
Thank you, Martina. Yeah, so my team at Bloomberg sits in the broader sustainable finance solutions group. And so we speak to investors a lot, and what we find, I'll say first of all, is that impact valuation is often key to what they need to know. What they're really looking for when they're coming to us is financially material metrics that can support their decision making, right? So we actually invest quite a lot in research to understand how all kinds of transition related metrics that we can get from transition plans or other information about a company that's transition related, things like energy mix, emissions intensity, capital expenditures, and the like, how they can actually link to financial performance of companies and to the risk of companies. And one example I quite like in this context is some research we did called Power Shift, which you can find online. And in this Power Shift research, we looked at companies adopting renewable energy, which it could be, depending on the sector you're in, adoption of renewable energy could be one marker of how much you're transitioning. It will impact, of course, your scope 2 emissions. And this research observed that firms that use the most renewable energy already, that consume the most renewable energy, deliver higher returns and superior risk-adjusted performance. And again, this research is online, so evidence like this can help to demonstrate to investors and others when transition KPIs become really decision relevant and they're not just disclosure points. So yeah, to your point, very much, we spend a lot of time capturing all sorts of data from transition plans, as I mentioned, and around it as well, that can help the analysis. We then also spend a lot of time normalizing that information. Comparability tends to be one of the key things that helps make this information decision useful. Every company can have its own transition plan, and of course, every company will have their own transition strategy, their own kind of markers that are relevant to them. But at the end of the day, investors and lenders as well tend to want to understand how a company is performing relatively within their sector or within some peer group. So the unit of measurement that's being used, which metric, which accounting methodologies behind the metric, the periodicity at which certain metrics are reported, all become really important actually. And so that's of course key to what we do when we look at transition plans. And then information is making sure that that information set is available, accessible, and comparable. And a final thing I might just mention there is when, just based on market observations, looking at the transition plans that are out there, or even green bond disclosures on transition, they often have KPIs that are very tailored to the issuer or to the specific project, and that specificity can help maybe for that company, but it doesn't really help the investor as much when trying to stack it off against other projects or other companies. So again, that's just where we spend a lot of our time.
Thank you very much, Edo. And last but definitely not least, Wiebke, I know you've done a lot of work also here, Deloitte and VBA, on assessing, for instance, cost of carbon, cost of inaction. We're looking currently at a resilience value indicator model together. I just like to get your views, and I know you have some slides as well that we quickly bring up too. When and where do you see the best demonstration of financial relevance and anticipated financial effects? Plus, when and where do you see the tagline from ultimately planning to prices, and how do monetized externalities actually sharpen, for instance, capex sequencing, hurdle rates, or asset level retires or retrofit decisions? When and where does that discussion sit and fit also with your client audiences, and what does that mean for the wider context?
Thank you very much. So first answer is we reduced all the impact valuation question on carbon valuation. We tried to focus on only carbon. This is the first issue that I want to put in. The next advice to give you, we are not in that call for an hour already. I was already asked if people have missed 40 more minutes. We dialed in very early to make risk management comes at a price. So risk management comes at our time. So you haven't missed an hour of this webinar. Just to ensure that I was asked separately. So the next thing, aligning carbon valuation with decision making. I'm absolutely answering the bigger introduction of the next study by showing you the former study, where we asked ourselves, how do we understand carbon valuation regarding the decision making? So Ralph from BNP just said it's a business model questioning, and this is exactly what we do here. And what Andreas from Effectual just said before, there are direct links between measuring and value creation. We align these two, business model questioning and measurement and value, into 6 key facts. We said that valuation as a tool for value creation, and it's the long-term value creation. This is very important. So transition is long-term. We all know that, but we have to stress that again and again to the people out of our bubble, because the budgets are short-term, the proof will be long-term. This is a very, very challenging motivation that we have. And then we have the next irony that one size does not fit all. And Edo from Bloomberg, you just stated the power shift research. So you also focused only on a certain sector, and you only focused on certain business models. This is so important, not only for carbon, but for any other impact measurement. The next is the corporate short-termism, which I just stated ahead. And the 2 last ones, early action pays off, is number 5, and bridging today and tomorrow. We have to understand that the core challenge is translating, and that's why we need this next study that is just coming up regarding the consequences into today's financial decision. And by the way, I was the one stating on the question on the bottleneck, what would saying there's another bottleneck for transition finance, it's in its adaptation, or it's at the end physical risk. If we do not handle transition right now, then the physical risks just make the transition risk redundant, to be really honest on that. And Ralph, you just mentioned that it's the future damages, and the earlier the future comes, the damages just overrule transition. So I highly recommend you to click on the link, and you're gonna get the slide if you want to read further. But that would be in a nutshell, answer on only carbon valuation focusing methods. Thanks, Martina.
Fantastic, thank you. And again, to remind everybody, the papers referenced by Edo and blog posts, and of course by Wiebke, are available as well in the chat. And feel free to copy paste from there. We will also share today's materials with this information, of course, post today's session. I'd like to move the discussion also a bit back towards KPI decision useful tools, and to understand maybe certain guardrails when it comes to impact valuation and externalities accounting methods. So, Andreas, bringing you back in, what makes a KPI decision useful for you, to you in this context? And what does it make measurable, auditable, time-bound, and ultimately, again, financially material? And where do you set at that portfolio level, potentially, where do you set the thresholds and certain step-ups or step-downs, potentially?
Well, the key criteria are for us is basically measurability, and reliable measurability at that, and the financial relevance or materiality that you mentioned, Martina. So these are the two key things. And we believe that externality accounting really sort of scores on that because, for one thing, we rely on a set of, physical measures that are usually reported by the companies, and if not, we can sort of estimate them. So those are not sort of things that are in the eye of the beholder, but those are, beans that you can actually count. So that really gives us a lot of comfort. And the other issue is when it comes to materiality, at least for the potential materiality, there is a huge body of research out there, academic research, that tries to come up with the valuations, with the economic valuations associated with those physical quantities that we observe, be it carbon emissions, be it water consumption, be it things on the social side. So there is something what we would think of as objective, and that's what we like about it, or at least there's a solid scientific grounding for what we do, and it's not preference based. So that's one big component, and the other, as you mentioned, is financial materiality. So how does that translate into the long-term value generated that Wiebke mentioned? And how does that sort of, as markets move from whatever they think of the asset price today to what is the long-term value of that? So there's a convergence of the market value, of the market price, to that. And we observed that, and we built strategies on that. And that the reason that happens, I think, ties into what Ralf mentioned, which is, today's externalities, if they're negative, they won't be tolerated. And if they're large and negative, they won't be tolerated. And if they're large and positive, they will be rewarded over time. There's this natural tendency that although there may be something wrong with it today, over time, there are strong economic incentives to actually correct those failures and get it internalized. So that's a reflection of what Ronald Coase said in the 60s, that there are sort of these societal forces that don't tolerate those market failures. And there's processes correcting those market failures. So it may look like a good idea from today's perspective to free ride on that. But over time, it gets sort of internalized and sort of even out. And that's what we see. So that there's very fundamental processes that are happening there, and that we can actually observe over time. And that's basically the case on which we rest.
Thank you very much. And again, further references on the Coase theorem and welfare economics and other type of references, also giving the academic economic theory context to be found in our white paper, and of course much more practical examples and how that's translated into use cases and practices for today's investment management, for instance, also to be found in there. But thank you very much for summarizing and referencing this again, Andreas, to set a bit the context, and maybe bringing in Edo on the KPI question as well, given Bloomberg as a data provider looks also at KPIs and methods. How do you look at these also from a transition finance management perspective, and what's a decision useful KPI for you? And maybe tying that into the broader data context, how is Bloomberg driving decisions together with investors in the direction of looking what's financially material and or relevant?
Yeah, thanks again. A very good question. So it is a difficult discussion typically because when we look at transition plans, there's a lot of new information that is being reported. And the transition is an unprecedented industrial phenomenon. So you don't always know in advance which KPIs are going to be the key ones. So there is some educated guesswork for which we work very closely with our clients, with investors, with other organizations that look at things like what does a good transition plan look like. And so we kind of try and bring those different pieces of the puzzle together to understand which KPIs could be the most decision useful here. But then in addition, and I'll repeat myself a little bit, but in addition, we also like to play with the data ourselves, right? We don't just hand it off and say, here's a data set, see if it works. We actually do research. So there is the power shift research that's linked in the chat that looks at one of these data sets, like renewable energy consumption, and sees, and asks, can we already see material financial, implications linked to this type of data? And sometimes we can. So we do look at that. And that's how we just try to make it more intelligible for our clients as well. The other thing that's really important, and I stressed it before, I'll just stress it again. What makes a KPI decision useful? Comparability, right? And so I think for investors, it's really helpful if there is some degree of industry alignment on which metrics they report against. Again, we also try to help with that on our side. If things don't match up exactly, can we do the right conversions to make them more comparable? But of course, it's easier when there's already some alignment in reporting. So in that vein, ISSB reporting standards, for example, as being rolled out across the world are very useful. And so, it's to summarize that it's some educated guesswork in combination then with also just the research of seeing, can we actually find the financial signals in this type of transition data?
Thank you very much. And linking that back really with the question on transition frameworks, and impact valuation methods and choices. Elena, bringing you back, how can transition finance frameworks such as, transition pathway initiative frameworks, for instance, or the IRGCC's net zero investment framework be aligned with impact valuation? Are there any specific areas when and where you see an opportunity when it comes to, for instance, monetized impacts versus physical units, water consumption, and so on and so forth? And maybe also then looking at your specific frameworks, and that's a question that always comes also in regards to reported information, right? And say scope 3 for GHG emissions data. How do you avoid double counting in this context? And what does that mean for the IRGCC?
Thank you. I wish I had a silver bullet. I'll start with metrics and then also share some of the reflections of theory of change. I think the main point really behind the ANZIF is that it emphasizes the necessity really of a need to use a dashboard of metrics. So to really understand the emission performance, you can't really have one single metrics that will solve for it all. It's combination of absolute intensity-based measures and financial and productions-based denominators. I think this is particularly crucial in the high-impact sectors and emerging markets where if we apply a rigid application of absolute emissions, it will actually undermine the financing the transition idea. So identifying emissions associated with climate solutions is actually key. Now, it's also recognized that a portfolio constructed with climate solution in mind will actually or may experience the increase in carbon intensity. Because of that, there's no single way to cut and slice these metrics, and they need to be used in combination, particularly as you raised the scope 3 that is not solved for, and IGCC actually recommends nuanced approach use it in the high impact sectors with caution, understanding the complexities and double counting problems. And to really wrap it, the theory of change within NZIF is that there's no single lever of change that will drive the change. There are multiple actions behind the asset level alignment, so portfolio construction, but also governance, strategic asset allocation. And behind this all is the need to allocate to climate solutions and emerging markets, sectoral and pathways that need a differentiated approach within the different sectoral pathways. I'll stop there.
Thank you very much, Lena. It's interesting to see, how we translate transition frameworks and methods and ultimately into portfolio construction methods. And maybe on that note, back to also first now, Ralph, very quickly again, when we look at product structuring and when we look at the work that also BNP is doing in regards to sustainability linked loans and bonds and how you embed impact valuation there, are there some sort of best practices, guidance, ideas that you could share? Again, they link, of course, to the use cases that we also reference in the paper, but going a bit more beyond that as well, when and where do you see debt levels and indices in the construction process here where impact valuation and externalities accounting is concerned?
Martina, thanks for the question. If we are looking at sustainable linked products in general, products to be issued by corporations, I'd rather say it's 99% linked to physical measures. So it's CO2 over all three scopes, it's water consumption, it's land use, it's maybe one or the other social indicator, but it's hardly ever linked to any kind of shadow pricing of impact valuation. And again, in this context, the question is quite important. What do these KPIs mean to us? I mean, it's good that a company is reducing its CO2 emissions over all three scopes, but let's assume it's relevant. It's somehow science-based targets, or at least science-based aligned, so it will have an impact. But from an investor's point of view, we have no idea at all what is the financial value of this. So we are not calculating the benefits or the cost of avoided or non-avoided emissions. It looks a little bit different it's also called bonds, but it's usually a smaller structure. It started in the social area, housing, other things, that you have a defined outcome. Usually the public sector is paying for this outcome. That could be a social topic, that could also be an environmental topic. And you have an investor that directly invest into these outcome-related transactions. And then at the end of the day, and you define just one outcome. So you focus either on housing for relatively poor people or improving health standards, categories like this. And then you do either underperform or overperform. And if you underperform, the investor will bear a small financial loss, so the return is smaller than intentionally thought. If you do overperform, if you fulfill more than you originally promised toward the public sector will additionally pay an incentive fee. But I've never seen that structure or a comparable structure with a large corporation trying to incentivize them to bring down their scope emissions or reduce water consumption, stuff like that. But there is hope, and especially when it comes to biodiversity and natural capital, I mean, you have so many different locations and so many different aspects to consider, and money would be the only measurable size that makes them comparable. So that is the common denominator. So I'm counting pretty much on transition finance to measure an impact valuation to measure biodiversity and its degradation or hopefully improvement.
Thank you very much. And tying this back to other practical examples, Andreas, very quickly as well, equity as well as private markets and/or index construction. You with Effectual are involved in all of these areas. As Ralph highlighted, sustainable finance, sustainable capital flows. We see here a real use case for impact valuation and externalities accounting. Could you give a few more practical examples when and where you're seeing this also from investor demand, asset owner demand, as you highlighted on the one hand, but also translating that into portfolio construction use cases, active or passive?
Sure. So from the asset owner perspective, there is sort of this, there's a high and significant interest in, impact accounting and externalities valuation because it has sort of this objective ring to it. So there is that sort of propensity towards that's certainly there. So it speaks to them in a language that they understand and they like that. It sort of couches sustainability in economic terms that they understand. So it's this communication issue. In terms of practical examples, the nice thing is that it's sort of applicable across the board. So it is applicable across asset class. It is applicable across illiquid and markets and private markets and liquid and public markets. So that also is quite appealing. In terms of practical examples, I mean, we see one of the largest investors, and it's public knowledge, Temasek, which is one of the two sovereign wealth funds in Singapore. They use that type of methodology. The people that we work for, obviously apply that. And it can be put into managed accounts. It could be put into funds. This is where basically our framework enters, and it's packaged in mutual funds and UCITS retail funds. But it can also be packaged into indices, and we're actually collaborating with Bloomberg on that. So that there is this technology. Let's call it technology. Of impact valuation or externalities accounting. There is that technology, and we're now at the stage that, first of all, we're taking this technology into practical applications. So that's a bit of a proof of concept, so it can be done. But there's also, sort of looping back to what I said at the very beginning, there is some evidence that it actually works from a financial perspective. So it works well from a sustainability perspective. Nobody doubts that, but it also works quite well from a financial perspective. And there is, that proof is basic, or the evidence for that is what we do. But the evidence is also more and more sort of being collected from finance academics and being put together. So there's and interesting papers out of Harvard and University of Chicago. All places that are probably not, too much under suspicion of being woke. So there is, hard empirical evidence that there is actually that connect between externalities and market valuation. So, putting all these things together, I think there's a compelling case for that.
Thank you very much. And in regards to anti-woke and then potentially greenwashing risk, I'm sure we're coming back to that, maybe also some public Q&A questions. I'd like to ask one more quick question back to Wiebke in regards to policy pull versus market pushes as well. Which regulatory standard setting moves do you see, and which ones would most accelerate actually the take up of impact valuation externalities accounting now in the different type of mechanisms and practices that Andreas and Ralph have described, and where do we go from here?
It's a shame because the more you regulate on a national basis, the more effective you are. But the market makes the regulators. So in the national, on the national basis, the higher effective you want to be globally over all the sectors, the less effective the regulator at the end is, because it has no direct impact. It's really a shame. We see from the ECB study that you may have seen in the beginning of this week that they have proven that credit defaults rise, that credit worthiness is getting lower, that capital costs rise, that there are changes that make brown penalty be felt and be dealt with in the market. So we can see that definitely. And the irony is that not even an hour ago, Trump just spoke at the WEF. So I would have answered these questions a week earlier a lot differently than I would do now. Market environment, I'm really of this confession now, and preferences of policies are changing that much that regulators are neither the carrot nor the stick maker anymore. And regarding the time, I would reduce and do not juggle with any abbreviations on SFRD, CSRD, Omnibus, and all those other things now.
Exactly. The layers of complexity, right, have not helped our courses and I think we're less building progression or pathways. They rather be putting freezes and barriers towards when and where we've been heading. But I think hopefully a lot of it will be proven the right way again once we see and once we move after the midterms. So we leave that comment here and there, but I'd like to open up the public Q&A, and I see already there was a question, for instance, from Armin Peter around the ECB report, Wiebke, that you have referenced. Absolutely, if and where we can put that into the chat for everyone and or into the Q&A box, we can of course share this. Just checking here to see, we have also put the additional materials into the chat. There's more to follow, so please watch out for it. And I'm encouraging everyone now to ask their questions. I see Antonio, good to see you here as well. He's asking, I think we are all aligned on the need to include metrics on the analysis. That's probably linking back to the KPI and metrics point. But until we can show explicitly that this leads to better decisions, it's hard to lend the case. He says we should have a clear pitch book readily available with those examples. And his concern is that outside carbon and in some areas, for instance, insurance, physical risk, the examples are really hard to find and to relate. We should work together on that pitch. And I would also say playbook. Absolutely, Antonio. I don't know if any of the panel speakers, it's not per se a question, but it's a wider statement. But if and where someone would like to add an additional remark to this.
Copy what Edo said. Whatever is material, financially material, of course we have to pick and take into consideration. If we could concrete it on carbon, we would be so much ahead already. But you're absolutely right. You have to think it broader. But what is at the end financial material? And I would only start there. The rest is for discussion for woke people at the moment. It's not the time for it. I'm really honestly say that it's not the time for it.
Yeah. Anyone else? Ralph, I see you unmuting.
Yeah, I did. I am doing. I wouldn't be as pessimistic, and I think starting with carbon is probably a good starting point. But and of course, as Wiebke said, we should focus on those topics that are relevant and material both for the corporations but also for investors. But nevertheless, maybe one or the other corporation has a topic that is probably not the widespread issue, but important for this company. And I encourage everybody to start the process and to apply not even a correct valuation coefficient, but maybe a randomly chosen shadow price, because every price that diverts positively from nil is a good one and leads to better decisions when it comes to future investments. But we have to work together on that one.
And Ralph, this is important for the bottom up. So for your own business model, it's absolutely decent. But on the comparability issue and top down, it's and for the VBA top down approach, it's way too challenging. I think for this year.
I do agree.
Thank you both. I don't know anyone else to comment here on this. I have otherwise also a question I'd like to ask to panelists again here. When we look at the next frontier, right, in integrating nature and just transition considerations, we're talking about climate and beyond, but also into transition finance without diluting the rigor. What do you see as practicable now, and where are we going from here, so that we can move that needle and translate what we have been working on and building theoretically really also into investment or capital markets practice?
Martina, I'll jump in here if I may.
Of course.
So, as you may know, that the main agenda for IIGCC is climate. However, more and more we see the other associated risks that come with it, and climate alone cannot be solved if areas like just transition or nature are not being taken into consideration. Actually, from just transition perspective, the social outcomes actually can drive the climate action or absence of it. We are shortly coming out with the official ANZF guidance on the topic, so stay tuned. Within 2-3 weeks, it will be published and available publicly. But really, it really stems from the fact that there are financially material, systemic, operational, legal, policy, regulatory, long-term value risks that can be translated into the valuation. Now, I get the point that it's accounting is not there just yet, and it is top-down approach rather than otherwise. Yet we see a significant institutional investors' interest and actions behind putting efforts into solving for this. So it not just sort of stays as a statement and commitment, but actually integrated through the components of asset allocation, asset alignment, stewardship, and engagement. So I think this is really important. And nature, likewise, no silver bullet there just yet, although we are convening a working group at IIGCC, and I see a lot of members here, so please, the recruitment actively going on, please get in touch with me if interested to join to find common ground there.
Fantastic. Thank you very much, Elena, and thank you also for that call. And again, it strengthens the points on collaboration, right? Also raised by Antonia, how can we get collectively there? And thank you, Armin. Thanks for your great contributions and seeing you there. I think we have answered the question in regards to the ECB study in the chat. You also highlighted Wiebke's comment is important. How is ultimately now impact accounting methodology been driven in regards to markets or policy developments, if I'm translating that correctly back into the question. Don't know, Wiebke, maybe a first reaction and final reaction. Apologies, we probably have many more comments and questions. We can also take them afterwards offline, but just quickly to get Armin's question answered, and then we are going into the second poll.
I don't think that it can be properly answered this time, and I don't think it can be properly answered on the national German level, on a European level, on a European countries level, and on a global one. I'm sorry for that.
And maybe that is the answer for today, then clearly. Thank you. And it requires absolutely more investigation. And I'm sure, Armin, Wiebke, you will also follow up individually afterwards. And maybe that's another keynote here, or a key point here for the concluding remarks. Clearly, we are aiming to conduct these discussions on a regular basis. This is the first of a series of webinars that we will conduct also around transition finance. then we will dive a bit deeper into different other target segments or areas and groups from insurance to banking and lending decisions. There is much more to come. But for today, now quickly showing the second poll. Mirjeta, thank you for all your support and assistance, and the team, Janne and Magdalena, of course, as well. Would you mind bringing the second poll on screen so we can literally get a bit more feedback before we wrap up on where would impact valuation change the decisions most? So we are moving back from collaboration also into individual, but also maybe collective decisions. Thank you again for making your choices. I don't know if we need to scan the QR code again, but I think people had it still. Thank you so much. Mirjeta had it on their phones probably. Thank you. Interesting, but then of course maybe no surprises. Risk management, risk and valuation methods also coming very clear out of our transition finance white paper. I referenced again the climate VAR and nature VAR discussions, that also linking back to research by Deutsche Bundesbank and others. That's of course where we see commonly as well a strong uptake, and then business model and strategy. And ideally that's where decisions from the top should start and ultimately will be then implemented at product level, and that's also here clearly highlighted. So I know we are at the end of the hour. I quickly like to summarize the key 3 takeaways from today: that monetized impact inputs make transition plans investable by clarifying priorities. We highlighted that, quantifying also the value at stake, and by enabling credible and traceable and trackable means of progress. Then clearly product terms when it comes to coupons, covenants, index inclusion, portfolio construction processes, you name it. But these should reference clear and auditable KPIs, aligned also with sector-specific pathways. We just simply didn't have the time today to dive all into these, but much more and many more references in the paper as well. These aligned to sector pathways and grounded in transparent methodologies and data controls and guardrails. Also the question around greenwashing risk, probably another debate for the near future, but also that's when and where quantifiable means and measures and metrics are absolutely paramount. And then thirdly, to demonstrate real economy outcomes and linking financing to execution and independent assurance that ultimately here also validates and can help to validate delivery, not just intent. So what I'd now like to do is to really refer back with a big thank you to all the panelists and speakers, experts today, also to the active contributors in the audience. Thank you for joining today's webinar, and thank you so much also for contributing to the white papers and other materials that you shared with us and that you were involved with and in. A last quick note, I'm showing here a couple of slides. One is the sustainable finance overview, the work we're doing at the VBA. Would be delighted to have some of you joining our work also in the sustainable finance context to move really the needle from ambitions to actions, and to join some of these discussions on a more frequent and maybe on a more workshop style basis. And that brings me really to the last note and information piece on the VBA. You might know that we are launching the Impact Practitioners Forum on the 3rd of February. Is here a very warm welcome and invite as well to everyone that's on this call. Please get in touch. Please register your interest. Please join the debates. We will look very specifically at a couple of examples from technical experts also, when and where we provide certain guidance documents, application information, and when and where we are coordinating also piloting feedback that's coming from the consultation process around impact valuation methods and ultimately metrics, KPIs and frameworks. And of course, the financial markets discussion is firmly integrated into the work we're doing as well at the corporate entity level. So a warm welcome. Would love to invite you all here. And with that, really to the last slide, thanking you all again. If and where you have further questions, please get in touch, contact us. A transcript and a recording of today's webinar will be shared with all and will be available publicly. Delighted having you here today, and see you very soon for the next edition.
Thank you very much, all.
Bye.
Thank you.
Thank you.
Thanks,
Bye-bye.